All right, good evening, everybody. Just give it another minute or so. Wait for some additional folks to hop on the call. All right, we'll give it one more minute and then we'll get started.
Yeah, Wednesday evening, probably catching that after hours traffic on the way home.
Exactly.
Maybe while we wait like that minute, we need maybe test out the chat feature. If you guys can hear us all right, just give us a thumbs up or
Yep. Wanted to mention everybody
fine.
will be muted, but if you raise your hand, we could give you permission to speak, or obviously in the chat feature, like Sean mentioned, you could drop any questions that you have.
Nice, very good.
All right, and they hear us. Beautiful. Okay. All right, so I'll get us started, and as people roll in, they could follow along. Uh, Want to thank you all so much for joining us on this Wednesday evening. Uh, Obviously, it's a little bit late in the evening, but we're excited to have you and RFG's first tax webinar. For those of you who do not know me, my name is Evan Brody, and I am the corporate controller here at RFG. And tonight we have a very special guest, Sean Lichterman of CAPSTAN. So Sean is a regional director and a tax expert, and he's put together a presentation for tonight to walk us through some tax strategies and tax incentives that could hopefully save you some money and give you some strategies for your real estate portfolio. As I mentioned earlier, if you have any questions, just drop it in the chat box. We'll get to them as soon as we can. There will be a Q&A session at the end of the webinar, so hopefully we'll hit everybody's questions. We're really looking forward to it. And with that being said, Sean, go ahead, take it away, introduce
Okay.
yourself. Happy to have you.
Thank you. Yeah, appreciate it. Hello, everyone. Again, echoing what Evan mentioned, really want to say thank you for joining this Wednesday evening. Digging time into your own personal lives, and especially you already knew. You knew the topic was going to be tax, right? Usually, those topics aren't the most well attended or uh, attended because right, tax is often just not that sexy of a topic. However, when you can tailor it to more of creating cash flow, kind of bootstrapping maybe your own incentives for, raising capital for rental properties, or if you own a business, or being able to apply this to your own network. I understand there's quite a few that work within the lending space or as brokers or with residential investors. This could really become a tool to then help them keep growing their portfolios, and at the end of the day, obviously reduce the amount that they owe to Uncle Sam. I'm sure we've all heard, right? Well, if you paid a lot in taxes here, it means you made a lot of money. It's just kind of the burden that comes with making a lot of money. And while that may be a little true, it doesn't have to always be the way of kind of growing your real estate empire or your business. So, I've got a couple of topics, we're going to go through today. I'll give you a little background, go through an agenda, but ultimately, I'd like to keep this pretty casual. If you have questions, please, enter them in the chat or raise your hand. We can even get you on mic here to go back and forth. But I'll give you a quick little background on myself. I first started within real estate, so I'm not sure, maybe like some of you here on the webinar today. But for those who have been in real estate for a bit, you kind of come across a few things, right? Appreciation's great, cash flow is even better, but boy, there are a ton of tax benefits out there for real estate investors, business owners, and that's really how I kind of ended up in what I do today as kind of a tax savings champion. But I work with CAPSTAN as a regional director. We only do specialized tax incentives, federal tax incentives for real estate investors, business owners, to really help bootstrap cash flow for these individuals. Again, right, we are a premier specialty tax incentives firm. We primarily specialize in cost segregation. It may be a household term, depending on how many may be familiar with this term. It's really the gateway strategy to higher level tax planning. So cost seg really is kind of your blueprint model for everything else. But we also do energy studies, R&D tax credits. So some wonderful tax incentives out there for real estate investors and business owners. Today, we're going to hop into cost segregation, right? What it is, how to apply it, how it's changed over the years. I'll go over a couple of strategies here: REPS, real estate professional status, short-term rental strategy. If you own or manage your own rental properties or even Airbnbs, you may have heard of this strategy. So essentially, how to apply this, how to participate, and then ultimately, how to advance losses to be able to offset your own personal or non-passive income. Energy incentives, as well as some capital improvements studies we'll do on the back end. Always like to finish it with some examples as well as Q&A. So that's what we have packed here. But again, the information here is just for presentation purposes. Do not take this as tax advice. Sean said this, so I'm going to apply it to my own tax situation. Make sure that you always refer to a CPA, tax advisor. We work hand in hand with those individuals, those professionals. So happy to hop on calls after this to make sure that we can understand and strategize with your specific situations. But first, going into it, right? So cost segregation, the vehicle for real estate tax savings. I think the best way to sum it up really is, no joke, this is actually brought up from a client that first applied cost segregation to their portfolio this last tax season. He's like, wow, I always thought time travel was cool, but I didn't realize with cost seg, I can get my future savings today. So that's really the premise or the back end or the benefit of cost segregation. But I'd like to take a couple of steps backwards from there, right? And to understand what cost segregation is, you really have to know what we're comparing this to. So whether you own a rental property, apartment, condo, long-term rental to Airbnb, or any brick and mortar business you see along the street, you typically have to depreciate that property. Now, when we say depreciate, I'd like to start kind of 30,000 foot, and then we'll narrow into, fine tuning the strategy. But depreciation may sound kind of interesting, especially when we're talking about tax savings. Like, well, if I buy a car, the moment I drive it off the lot, it depreciates in value. Isn't that bad? Correct, right? But when we position that actually with a business or with a rental property, that depreciation is actually synonymous with deduction. So essentially, the IRS knows that your property is going to go through, all the assets within it aren't going to last forever. So for residential properties, for instance, it was on a 27 and a half year lifespan, whereas a commercial property is on 39 years. So when you purchase a property, you take the difference less land, and then that is depreciated either over 27.5 years for residential or 39 years for commercial. So you essentially get 1/30th or 1/40th of that value each year as a deduction, right? As a tax benefit to apply towards your taxable income. So when we understand that's the baseline, that's the default method, how does cost segregation then work? Well, rather than waiting 30, 40 years while I own this property to get that total tax benefit, wouldn't it make more sense if I took the assets within a property, say for instance, the carpeting, which has a 5-year lifespan, and that's going to get wrecked and ruined probably sooner than 30 or 40 years. So wouldn't it make sense to classify that in its proper class, identify it as such? And when you do that, and usually outline a number of other assets within a property, you're accelerating your deductions, you're accelerating your depreciation, you're maximizing your deductions in the years that you own the property, not having to wait. So that's really the difference between the two when we compare these, is that you're not getting any more, any less in terms of tax benefit. It's just the timetable at which you receive it. So it's the time value of money concept, right? My dollar today is worth more than my dollar tomorrow. Likewise, my tax benefit today can be worth more than my tax benefit tomorrow. So in a cost seg study, if we look at a residential property, what are some assets that we're typically looking at kind of segregating out or putting in its proper lifespan? Well, a single family home, that could be quite a few items, right? It could be the driveway, for instance. It could be a backyard shed, a patio, a pool, fencing around it. Inside, it could be the furnishings. If you're doing improvements, or maybe you're gutting out the kitchen or the bathroom, those specialty tile or assets or lighting you're putting in there, all those fixtures could have a shorter lifespan. And when we throw an engineer on site to actually allocate the proper classification, we're able to enhance the deductions in the early years. So when you do cost segregation, you typically want it done by an engineer, someone who has both experience and knowledge within construction, because you're looking at blueprints, you're looking at drawings, you're looking at the general contractor reports, but you also need to be savvy within accounting, finance, and the tax code ultimately. And we verify all of these values by the maker's lifespan. So modified accelerated cost recovery system, that's how each of these assets come up and qualify for their values. Now, you don't only, or I guess cost seg is not only applicable or eligible for rental properties, but also commercial properties. So similar aspect, if we're looking at an office building, kind of dissect it, what items fall into personal property, say FF&E, what items are going to fall into land improvements, think parking lot, drainage, signage, fencing, the whole 9 yards. Each asset class is going to have its really own respective assets that go with it that can be eligible for acceleration. But in either case, whether you're doing cost segregation or using the default method of straight line, you have to attribute a value towards land, because land is a non-depreciable asset. And this may actually, I wouldn't say it's a strategy, but it's something to actually look at if you're looking at between, one, two, or maybe a handful of properties, because since land is a non-depreciable asset, we have to actually back that out of your basis of when you're depreciating this property. So there's some common ways to look at it. Right, first, we got to identify, go to the tax card. The county tax assessor, it's kind of their job day in and day out to go ahead and assess what's the building value, what's the market value, what's the land value, and then come with a total. However, what about places like California, Chicago, New York, where land comes at a premium? I mean, there's tax cards that we'll look at, for instance, a vacation rental on Santa Monica Beach, the land value will be assessed at like 86%. That's just insane, right? So it's a lot of value. So you're eating up a lot of your tax benefit. So in those instances, we can look at other ways or other avenues to substantiate your lower land value, essentially either an appraisal. You can also look at your insurance coverage breakdown. What's the replacement cost of the property? We can also look at a broker opinion of value. I guess one thing to really take away from here is that one, right, land is not depreciable, but then two, the 80-20 rule, 80% towards building, 20% towards land, is not always defensible. So don't just kind of live in kind of die there. It does behoove you to look at the tax card, because sometimes it actually could be more favorable depending on where you're purchasing. It may be somewhere more rural or undeveloped, for instance. And on that subject, not all asset classes produce the same amount of tax benefit, right? A single family home say across the board on average, maybe 20% of the bill of the properties we can accelerate. So give you an idea, let's say we got a $500,000 rental property, roughly 20% of that we're able to put into those accelerated buckets. But that can change depending on the asset type, right? So if you have clients, or perhaps maybe you invest as a limited partner in some of these asset classes, and you may see differences in losses or in your K1s depending on those types of properties, right? So apartments, that can vary widely. I mean, think of your kind of courtyard style apartment complex, maybe C class, all the way up to A class amenities where there's mixed use retail. Is it downtown? Is it urban or rural? Um, Hotels certainly can be quite dramatic of a change, right? Is it kind of like a Motel 8, or is it a highly amenitized resort, for instance? But if you look down here, you'll see mobile home parks, car washes, gas stations, and these kind of reign supreme in terms of being able to throw off large deductions because of the specialized equipment or some of the favorability they get under the tax code. So, for instance, mobile home parks, those do fantastic because depending on the ownership of the pads that the homes or the mobile homes are sitting on, those can actually reclassify as 15 years, so it's all bonus eligible. And we'll get into that in a second. But car washes and gas stations, some of them can actually ultimately the entire basis can be written off or qualify for bonus, so it's eligible for a first year write off essentially. And again, that's based on certain criteria being met within the tax code. For car washes, is it a tunnel type, conveyor belt type style of property? Essentially, there's no retail on premise. And for a gas station, there's three criteria. You really just have to hit one, but are 50% or more of your revenues generated from petroleum sales. Oftentimes that's the case, so it's easy to qualify those as such, and then be able to write off the entire building. So really what this boils down to is if you're working with any type of maybe niche investor or investment groups, and if they're looking or they need substantial losses, it may also help them to navigate to these other types of asset classes where they can get that same cash flow, same cap rate, but then also have a larger deduction for either investors or for the group themselves because of the very nature of those property types. Now, I'll just take a quick kind of pulse check, right? If you don't have to, right? But if you're familiar with cost seg, right, you can put a thumbs up, or bonus depreciation, put a B. I think that one's probably more of a household term. Most individuals know of bonus depreciation probably from either TikTok, right? Go buy a G wagon, it's bonus depreciate bonus depreciate eligible. I'm sure Evan's probably seen and heard of that
Right.
a lot.
Yep, many times.
Yeah, this is a little bit again different bonus depreciation. We're talking about essentially bonus depreciation, cost segregation. They're a match made in heaven. They go together very well because essentially in a cost segregation study, we're looking for those shorter assets with a shorter depreciable lifespan, like 5, 7, 15 years. Well, bonus just so happens is applicable or eligible for assets that have a 20 or less than year 20 or less than year lifespan. So essentially, everything that we find in a cost seg report becomes bonus eligible. So that's why I say these two go very well in hand. Bonus has been around really since the early 2000s. We've kind of had it play on and off, but it really was back in the Tax Cut and Jobs Act. So back in 2017, that was really our first time seeing 100% bonus, but for so long. We had it for like 5 years. So it was tremendous for investment groups, ma and pa investors. The Airbnb market blew up, rental market blew up. It really helped, especially at a time kind of 2019, 2020, where interest rates were low. But then we also saw a lot of movement within different assets, even when cap rates and lending went up as well, which would kind of would be very home for your industry. This became a tool to ultimately try to use or to showcase that if some properties were not penciling out, they actually may still benefit based on the tax deductions there because we had such high bonus eligibility back then. So it wasn't a phase out in the last couple of years. It was phasing out 20% each year. However, like Arnold Schwarzenegger himself, right? Bonus is back, baby. It's been reinstated this year. It got passed in law actually on July 4th. So while some of you may have been shooting off fireworks and celebrating with a hot dog, others, myself included, were stuck to the screen waiting for the bill to get passed. This and a few other tax provisions were written back into law. So this was a big one. We've got 100% bonus back. It's made permanent as part of the tax code, meaning that there's no phase out or sunset schedule. So, kind of give it a wink, wink forever, because it really just takes another administration to kind of change it. But this really does help for strategizing and planning. And again, right, this could be applied towards, your basic assets you'll find across multiple types of buildings. Your flooring, your moldings, your FF&E, your parking lots, your fencing, could be pools. The list goes on and on. But an easy kind of back of the napkin is that roughly 20 to 30% of any property you look at is going to be bonus eligible. And that's kind of an easy way of just being conservative to say, if I'm looking at a rental property, if I'm looking at a commercial property, again, the lower value of the property, I would probably tack that back a little bit, but kind of industry average, would say 20% is pretty safe play. And to really kind of showcase, right, bonus, how it's so effective. Well, let's take a look at this example here. We have a $37.5 million basis on this property apartment complex. If the bill did not go in place, they'd only be looking at 150,000 first year tax savings, right? So a far cry from 3.1, so essentially 2.5 times. So this really has been a great lever that Congress typically likes to pull here and there, and incentivizes, again, real estate groups, investment groups, investors to go out and do just that, grow geographies, and it really helps kind of cities and towns and states to really grow because of these tax incentives that they put out there for individuals. So getting into that, right, who can ultimately benefit? Well, commercial, residential properties, you got a rental, investing groups, syndication groups, brokers on the lending side, essentially anyone who touches or has some type of play into the real estate side or even business, right? It really helps you kind of differentiate yourself, help strengthen client relationships, but not all things, right? It's not all rainbows and gumdrops. There are some potential drawbacks or where cost segregation just may not make sense. Again, the biggest thing is that it's helps to offset a tax liability. So if one, you don't have a high tax liability or you have no tax liability, again, we're kind of just creating deductions and you're storing them in a bank that you can't utilize today. So you really don't feel the impact of it. Otherwise, if you are doing a short-term ownership or you're flipping the property, so let's say you buy a property, you're going to sell it in 1 to 2 years, you're going to be susceptible to what's known as recapture. So essentially, think of cost seg, all of those front-loaded deductions that I received as a taxpayer, as a business owner. It's likened to an interest-free loan from the government. So when I go to sell my property 1 to 2 years, Uncle Sam goes, "Hey, remember that $100,000 we lent you in the first year when you did this cost seg? Well, now you just sold. We'd like that back at your current tax rate." So it could be quite high. Again, there are a couple of ways to mitigate that, right? If you're familiar with the 1031 exchange, it's been around for 100 years. You can essentially just kind of buy, defer, die is the strategy. You kick the can down the line. So with the 1031 exchange, you can defer your capital gains as well as your recapture into another property of like kind. You can also do what's called a DIY, essentially a DIY 1031. You essentially sell the property, get hit with the recapture, buy another property, do a cost seg. So there are a number of ways to mitigate that, but I'd say if you really want this to work properly, your goal in mind is to grow your portfolio, because by reducing your tax burden, that cash flow that you otherwise would have paid to Uncle Sam, you can now reinvest into your portfolio, either acquiring a new property. You can use that towards improvements. You can use it towards employees, maybe technology. But the whole purpose of it is to free up cash flow that otherwise is going to go sit in Uncle Sam's pocket that you're now redeploying into your own. So that's really the advancement of cost segregation with bonus depreciation. If you're going to buy a property, flip it, kind of take the money and run, it does you no good because of the potential drawbacks of recapture. Or again, let's say you're carrying forward a bank of losses. You're just not going to feel the impact today. But the good note is that even if, let's say, I've got a tax burden of maybe 100,000, but I do a cost seg and it produces 500,000, so I've got more than I need. It's not a use it or lose it scenario. You can actually carry it forward. So that's kind of a nice point to this, is that it may not just help you 1 year; it may actually help you 2 or 3 or multiple years. But any Star Wars fans here? Really, the guiding light here is right. Whether it's yourself, it's your network, it's the individuals you're working with or you're advising. Be their Yoda, right? Help them. They typically need a guide to introduce tax savings opportunities. It's not only on the accounting community to service this or even bring this up. Oftentimes, some CPAs just don't do it. They don't do themselves, because of that aspect of having an engineer construction background. Just because they have an accounting doesn't always transfer to the other side. They may be able to identify a few assets where essentially I call it like a CPA special. They'll take kind of the flooring, the kind of cornerstone fixtures and assets, apply them into their proper lifespan, and then also apply bonus. But ultimately, you're probably leaving quite a few other assets on the table, thus, kind of deductions on the table. But at the end of the day, right, friends just don't let friends overpay on taxes unless you secretly hate them. So it really is a good strategy to kind of, intermix with your community. If you're on the lending side, the brokerage side, it's a fun strategy to bring up to see, especially for those who have goals in mind to grow their portfolios. It could really save them quite a bit on the tax burden side to then be reinvested for further growth opportunities. But enough of me kind of rattling through, some of these definitions. How about we look at, the proof in the pudding? I think that's, usually the contender that really showcases how this operates. So on an acquisition side, right here, we have kind of your typical multifamily property, probably an A class. This has a clubhouse, it's got an office, it's got a pool. We can see it's quite a high depreciable basis, but this is why it could be great for investment groups. And then we'll get into a couple of other examples for mon pa kind of real estate investors as well. But even at $38 million basis, again, right, this would be what they purchase it, less land. And then they can also add in any improvements. But by doing the default method straight line, they'd be getting a deduction of 1.3 million. Sounds not bad on its own. But when we look at doing cost segregation by accelerating a lot of those assets in their shorter lifespan, we ramped that all the way up to 8.5 million, yielding a $3.1 million tax benefit for this group. So with that, again, they may not utilize the entire 3.1 cash savings, or they utilize a majority of chunk of that, and that's now a new down payment for another multifamily property, or it helps them acquire technology or employees or make some improvements down the line. So it really becomes the kind of free money that you're sitting on. If you take an economics class, there's no such thing as a free lunch. But in this essence, right, you may not have to go out to the bank. You may not have to blend, or if you are lending, at least this helps you not default on some of your loans, because you're not having to worry about that tax burden ahead as well. In this case, we have an urban high rise, similar, smaller basis, right? Just 4.5 million. Deduction first year cash savings 270,000. In these examples, I believe we use about 35% tax rate. So essentially take the deduction, multiply by your tax rate, that's your cash savings. But again, the deduction or the cash savings value may differ depending on your tax rate. That's why I think it's always good to look at the deduction value versus the straight line value, because that truly is a one-for-one kind of difference. Would you rather have 28,000 deductions this year or almost 800,000? It's quite substantial. Here we have a mobile home park, just shy of 1 million. Again, 25,000 doing the default method, straight line. By doing bonus depreciation with cost segregation, because these these asset classes are highly favorable, and we can accelerate a lot of assets within the properties. This yields quite a substantial benefit on just a $960,000 basis. Almost a $240,000 cash savings. Similarly, with a car wash, right? Car washes, again, kind of reign supreme, especially if they're self-serve or conveyor belt type. It's kind of like having like Switzerland in the U.S. because it's a nice tax haven, if you will. If you're an investor or you work alongside an individual who really needs to offset a lot of tax liability, go tell them to go invest in a car wash because of the amount of deductions and losses that it can essentially portray on paper. Here we have like a $4.5 million basis, right? The whole property becomes bonus eligible. Essentially, you write off the entire basis, less land. In this case, the difference is bonus. This 2024 had 60% bonus eligibility, so that's why it's 2.6 rather than the 4.4. But quite a large benefit in the first year. Hotels as well, right? $55 million hotel, $4.5 million cash savings, a warehouse. This could be done on build outs as well. So either leasehold improvements, tenant build outs, triple net leases, retail sector. Doesn't have to only just be new construction or acquisition type of brick and mortar properties. Here was a Rite Aid. They spent, in this case, $2.5 million to build out. I think this was an old bank, and then turned it into a Rite Aid. Again, be able to accelerate a lot of those assets into their proper classes, add bonus, and bam, you're front loading a lot of tax benefits in the front end. But here we get into short-term rental loopholes versus real estate professional status. I think this will probably be very close to home for maybe most on the call here today. So we're going to spend quite a bit of time and going into some of these strategies, how to qualify, the criteria, go through some examples, but then ultimately how this could help you as an individual if you own rental properties or Airbnbs to essentially kind of garner that cash flow and create your own real estate empire by offsetting your non-passive or otherwise active income.
Hey, Sean, just a quick so BJ actually just posted a great question. Says, keep hearing mixed information. Is it true that you can't take advantage of bonus depreciation if you have a W-2 job and you're not a real estate professional? So I think that kind of is going to loop into this, right? It's the passive versus non-passive. So
yeah, great. Yeah, I appreciate that. It's almost like we segued you up to where we're heading to. I'll give you kind of a short answer here, and then I'll also elongate it on this side. So here's the tax code. Tax code's not always black and white, but you know what is black and white? Court cases. So that's how we always kind of advise by what we've seen. Rep status is probably the most heavily scrutinized strategy out there. It comes up in audits all the time. Not that it triggers them, but just because a lot of individuals either incorrectly apply rep status, or just because they have a real estate license or they're a broker, they claim themselves as a real estate professional, and thus that's why it may go into an audit and then they fail it. So in terms of court cases that have passed W-2 individuals with rep status, I've only seen one. So many of them do not favor having a W-2 job. And the reason being is because of the criteria. It's a massive amount of time that you have to showcase. So as a W-2 employee, right, the way that the IRS deems this is that how do you do a full-time job, but then also meet this bucket of material participation as well as the hours, the criteria. So to be a real estate professional status, you have to spend 750 or more hours, right, annually, and over half of your total working hours in a real property trade or business during that year that you applied for this status. So the difference here is that it's an actual designation made on your tax return. So again, just because you hold a license, real estate, or you're a broker or you're in lending, does not automatically qualify you for real estate professional status. That's kind of one of the most misconceptions out here about this strategy here. The other is the actual commitment. And again, for this one, really work together with a CPA, a tax advisor, because not that you have to submit your hours when you're tracking for this status, but it does help, because in that unlikely event that should be reviewed, the first thing they're going to want to review is your hours. Did you actually participate in the property? Let's see it. What was that activity? What it looked like? Because not all activities actually qualify as well towards your hours too. So a couple of defining points here. But right, this can apply towards commercial residential properties. So if you have residential rentals, like BJ sounds like he has here, or you're maybe an investor in a commercial property, or you own a couple of commercial properties yourself, you could lump those together and become and group activities together to then meet this rep status, to be able to essentially, when you apply a cost seg to those properties, the cost seg generates deductions or paper losses, right? On paper, it shows that you lost money. Well, we use those deductions against your taxable income. That's where the benefit comes from. And without this status, you're actually limited to the amount that you can take from rental properties to your non-passive, otherwise active income. Um, and by meeting this criteria, the real estate professional status, it allows you to open up those losses, those deductions, without limitations to then be able to offset your non-passive or active income. The other benefit here is that it can apply towards your partner. If you and your partner, your spouse, you file jointly, this becomes a tremendous benefit, which is why you may see doctors who have a spouse or a partner who manages their real estate, because they qualify for the rep status and they offset the doctor, the lawyer, the high income earner. They offset that income. So we've got a couple of stories here, a couple of examples we'll go through, but the IRS does also highlight what types of activities kind of correspond to a real estate property or trade or business. So that could be anything with development, redevelopment, construction, property management, leasing, brokerage, acquiring, rentals, etc. There's about 11 of these that they highlight. So very key to make sure that you fall into one of these categories, and that again that you're participating with the hours, but then also over half your working time is also dedicated in that trade or business. So, for instance, right, I could be a commercial real estate broker. Over half of my time is dedicated within real estate trade or business, but then I also have my own rental properties on the side, and I manage them myself. I meet the hours. I have the threshold. I can then cost seg my rental property to offset my brokerage income, my commissions, whatever I made that year. So it could be a good strategy for those individuals as well. So kind of touched upon this right for a second. It's the rental real estate losses are non-passive, right? So that's really the benefit of the real estate professional status. Normally, right, your rental losses are passive, so they can't offset your W-2 income or other derived income, which is why you have to participate. Again, I've seen maybe one court case that's allowed this, and it was an individual, I think, who worked part-time as a W-2, and then he actually worked crazy odd hours, like overnight, on his real estate business. So I guess long answer back to you, BJ, is just be careful, especially if you're W-2. The court cases aren't in favor, but just make sure you're working alongside a CPA or tax advisor on this. Yeah, kind of just rehashing this, right? So the reps removes that limitation, allows you to offset a lot of that non-passive income from either your commissions, your business income, your capital gains. W-2 income, you can say that there, but that's only if, right, your partner, your spouse, if you're filing jointly, qualifies. So it could offset theirs. Again, yeah, right. So reps, not just for landlords, right, applies to a broad term of real property trades or business. Here's just a small sample of them. This is why you see a lot of brokers, developers, property managers often qualifying because of the very nature of their business, what they're doing day in and day out. And then if they go manage properties or if they go and purchase their own portfolio, they typically can meet that threshold, thus being able to offset a lot of the taxable income that they're generating. One thing I like to joke about is that I think there's $1 million idea for a dating matchmaking either app or site, and that's simply by taking real estate professional status individuals with high income earners and somehow pairing them together. I think that would be, I think that would do quite well.
I'll invest in that, John.
That's right. Yeah, I think you and I will do that together. So to put a bow on real estate professional status, kind of wrap this up, right? It really allows you to utilize those losses kind of expand them across their limitations, especially if you're using cost segregation and bonus depreciation. Again, if you have a spouse or a partner you're filing jointly, this can ultimately benefit both of you. Or go purchase some property, you yourself or your partner then goes and manages, meets the criteria. Now you're able to offset quite a bit of tax deductions that way. Again, right, just need one spouse to qualify to materially participate, and that can actually help both of you if you're filing jointly. Um, and at the back end, if you have commercial properties or other residential properties, rentals, you can actually group these elections together to kind of have a little easier go at the participation and meeting those hours. So here we have an example, right? I've kind of flubbed the names just for anonymity, but we have a broker and his wife. They file jointly. Brokerage, right? He's in a real property trade or business by default of his job. Sarah and John, they both manage their 5 rental properties. They're handling the leasing side of it, the coordination, the maintenance, etc. Right? So they're able to document their hours significantly on here by hitting that 750 hours a year. So they meet the rep status. Now the goal is to then use cost segregation to maximize their deductions to offset their joint income, any commissions, the bonuses that they've received. We did. They have 5 rental properties. The average value of all of them were average value of each of them was roughly 350K purchase price. So these weren't large, astronomical properties by any means. Kind of 2-2-2-1, 800 square foot apartments and single family homes. We did cost seg on the portfolio. So, if we take the land out, it's roughly a $2 million basis across all this, maybe a little less. We were able to save them $250,000 in first year deductions. While AGI and adjusted gross income between both the two individuals was just shy of $500,000. So we're able to cut that essentially in half by doing cost segregation, essentially saving them $90,000 in taxes that year. So with that 90,000, what they then did, they were able to put that as a down payment on a new property, right, for 350 or right around 300,000, and then the remaining 40 or 50,000 they had left over, or essentially the cash flow that they had left over, they went and utilized and put that into repairs and improvements into their current portfolio and actually increased their rental income. So that is a clear kind of example of how to use the tax code, how to use cost segregation, bonus depreciation, as well as some ample tax strategies out there like qualifying for real estate professional status to, one, reduce your large taxable income, but then also to generate that cash flow and repurpose it back into their portfolio for something that's also going to be cash flow generating, that's going to increase and produce income for them. Last little note here is that, right, just because of 250,000, they actually had the potential. There is potential to actually reduce that taxable income to zero. So let's say, they had a lot more than we found, or they had 10 of these rather. They'd be able to actually offset the entire taxable income. Again, whatever they had in excess, they'd be able to carry forward for future losses as well. Now, the short-term rental loophole, I love this one. I think it's becoming more popular. Probably in the last really 5, 7, maybe last decade, because of the onset of bonus depreciation. 100% bonus depreciation really opened the playing field to these residential properties that have a basis of like 200, 250, or $300,000, because you can just write off so much more in the early years than you were in the past. The other significant benefit of STR loophole or strategy, however you want to call it, is that you don't have to give up your day job, as a broker, or essentially your W-2 job, to get into real estate 100%. You essentially can kind of moonlight in it. Now, even though they still call this a passive activity, there's nothing passive about managing an Airbnb. I'll be the first one to tell you that. Um, but with the short-term rental loophole, and it may sound finicky with the name, it is regarded by the IRS. By doing this, you're not putting yourself up to IRS scrutiny or being audited. But again, there's a good way, there's a right way, and there's also kind of incorrect or sloppy ways of doing it. So with anything with Uncle Sam, the IRS, you want to make sure that you're dotting your I's, crossing your T's, especially when it comes to, I'm going to utilize not paying you to then take that cash flow and repurpose it into my own portfolio. So with that, you kind of get to act as a quasi real estate professional in the sense that you're taking your passive losses and you're offsetting your non-passive income. So it's the same thing. So back to BJ's question, as a W-2 income earner, maybe rep status is kind of dicey, especially with the criteria and hours that you have to meet. But if you turn that rental property into an Airbnb, where your average guest stay is say 7 days or less, and again you participate, you manage the property yourself, you then could also, at a less stringent criteria, be able to take those same losses and apply it to your W-2 income to offset that. So this may be an avenue we're seeking or looking into. Again, it only applies to short-term rentals, whereas rep status, that could be long-term rentals, condos, apartment complex, gas station, car wash, any brick and mortar. That applies to every asset class out there. Short-term rental has to only be short-term rentals. So average guest stay, 7 days or less. It also could be up to 30 days, but you have to have some type of professional service. It could be like a nightly turn down. Maybe you have a kitchen staff. Again, think of it as like running a boutique hotel or like a B&B, a bed and breakfast. That's the type of service mentality you have to have. Guest stays can be up to 30 days on average, and then you can also qualify as a short-term rental. The other note with short-term rentals is that the IRS really deems these as boutique hotels. So as such, these are actually depreciated over 39 years, similar to non-residential or commercial property. Whereas rental properties, if you have a tenant in place, those are 27 and a half years. So you may first think, 39 years? Well, aren't I getting, that's a lot longer. I'm getting far less chunk over that time frame, which is correct. But by turning it into a non-residential property or commercial asset, it now opens you up to other tax strategies that we'll get to in a second, QIP, some capital improvements you can also apply towards it. So it actually does kind of bode well for these types of investors. But get back to the criteria, participating. There's a 100-hour, 500-hour test. Most individuals are going to meet one of these two criterias. Essentially, the 100-hour test is that you manage the property 100 hours more than the next best person in line. That's comparing it to another investor that's involved with you. That could be your cleaning crew, could be your handyman. You just have to have 100 hours more than them. So let's say they accumulate 50 hours, you need to have 150, right? I think my math is correct there. Or you accumulate 500 hours annually. So far less criteria when we compare it to rep status, where it's 750 and over half your working time has to be in that real estate business or trade. This is doable. Not easy, but it's doable for a W-2 individual to manage their Airbnb. Again, anytime you have to work with Airbnb, guest interactions, maintenance group, anytime you're working with that business, essentially, because that is a business that your boutique hotel, if you will, that is activity going towards your hours. So make sure you track them. There's a number of apps you can utilize to help track that. But this test, or these two tests, are typically the ones being met by W-2 individuals. And again, right, this is a nice creative solution for W-2 income earners. Whether you're a doctor, you're a legal professional, you're a tech, you're trying to grow your own Airbnb empire, this is a phenomenal tool to help you dip your toe into the tax code, also manage some property, but not have to give up your W-2 job in the same sense, and then also be able to utilize the tax code to your advantage. So here we have a nice example of this being put to use, right? So we have a local investor. Actually, I'm out of Tampa, so this is a software engineer close to Tampa Bay. Worked as a high-end software engineer for a large company. You may have heard of it, Google. But built a couple of short-term rentals in the area. All four properties, roughly the base came out to a little over 2 million. We were able to save him in cash savings over 200,000. So that I think, if I remember this correctly, it wiped out like his one. I think it was his first 2 or 3 years of tax obligation from his software engineer job. So it was pretty cool. He was still getting cash flow because I mean Tampa is kind of blown up in the last few years, so he's getting a lot of renters, and it was producing well on an annual basis. But then he was also to offset his high engineer, his high W-2 job, and what he did with this cash savings then over the last 3 years was then repurpose that into other businesses and actually open up a couple other short-term rentals and kind of rinse and repeat, do the cycle all over again. So Again, using the tax code, using the strategy effectively. So improvements that what we focus on in the beginning is really acquisition, maybe slightly new construction. But when you hear maybe anyone in your network that owns commercial business or has a rental property, or even a short-term rental, and you say, or you hear them kind of discuss, oh yeah, we got some improvements we're putting in, we're doing some renovations, we're making some upgrades. Those are always trigger words for my ears. So I'm thinking, bam, those are incentives, right? If you're making improvements, whether it's commercial property or not, there's probably an incentive out there. I think I just saw a question pop up, so let me
Yeah.
pause.
So looks like Matt said, can both partners of a business be tracking rep status if filing jointly to count toward deductions, or is only one of those individuals allowed to have their material and non-material hours counted?
I think if I'm understanding this, you're kind of asking if both partners. Okay, I get it. So only one of the partners actually has to meet the criteria of rep status and participation within that real estate business or trade. And you only have to meet that one if you're filing jointly, right? Because both of your incomes kind of flow together, you're filing together. So then only one of you would have to actually meet that. But what you can't do is kind of say, um, all right, kind of in the back that last example, I forget, I think the John and Sarah example. John goes out and does brokerages, but then Sarah stays home and watches and does the participation of the rental properties. It has to be that one individual doing both to meet that criteria. I think there's another follow-up question, so we'll wait for that in a second. But I'll fast forward on the screen here. So I won't spend too much time on the 179D, but I think what's good to know here is that if you do have anyone that's working within commercial property or non-residential properties, even if it's residential, as long as it's 4 stories or higher above grade, if they're making improvements and ultimately those improvements are going to enhance the overall energy efficiency of the property, there could be an additional deduction just because of that energy savings. If they're putting in new lighting, so like, say changing to LED, or they're changing the HVAC system, or maybe it's some insulation, it's improving the building envelope of the property, they can actually, based on the square footage of the property and the overall energy efficiency of those improvements, could actually add an additional deduction between $1 per square foot up to $5 a square foot indexed to inflation. So here we have this year, right? This could be as high as $5.81 a square foot. On a 100 square foot warehouse, for instance, right? That's $500,000. So this could really be the cherry on top for those commercial investors, especially if you're working with those individuals who own, buy, and operate businesses, commercial property, warehouses, manufacturing plants, anything that has a large footprint, and they are making improvements. Cost seg, again, right? Great baseline, as we talked about. It's the gateway. So you essentially accelerate everything on the front end. But if they are making improvements to that property, they're also oftentimes qualifying for these energy factor. It could be a nice deduction or a nice enhancement to either plan, strategize, or kind of cherry pick in the years that you apply this. So maybe upon acquisition, you take the cost seg deductions, years 2, 3, 4, 5, you do some improvements, then you do an energy study, and you're also getting deductions there. So you're always keeping your taxable income manageable or low, and you're keeping cash flow coming through the business. I'll go through just one example here, but here we have seeing that multifamily property, 361,000 square foot. So it's quite a large footprint. They achieved the energy savings factor as well as prevailing wage. In this case, they didn't have to. So they got to $5.36 a square foot, netting them nearly $2,000 in additional deductions. So this is on top of what they've already received from the cost seg bonus side. So again, you can start stacking or layering these strategies kind of either in tandem or over the course of ownership. And when we get to qualified improvement property, again, this is a nice benefit for non-residential. I kind of teed this up when I talked about short-term rentals, but essentially, if you're making interior improvements to a non-residential or oftentimes a commercial building, say you're putting up drywall, you're putting in fire suppression, some security system. There's a number of assets that typically don't qualify for either 5 personal property or land improvements. In this case, because you made those renovations, or those improvements after the property's already been in place, you can now take a larger chunk by qualifying those assets as 15 years and thus become bonus eligible. So to give you a real life example, working with short-term rentals, you may acquire kind of a turnkey property, get it up on Airbnb, maybe in 2 or 3, 6 months, or even a year. You make some improvements. You maybe put up some drywalls, maybe some interior framing. A lot of those assets then could qualify for QIP, which then is going to enhance your overall first year deduction. So rather than looking at a 20 to 25% accelerated, kind of across the board accelerated on that asset class, maybe it's now 35, maybe it's high as 40 or 45, depending on the assets and the improvements you put into the property. So this really just boils down to timing. So we can either start stacking strategies or the timing at which we do our improvements. But as we get to a close here, really just want to kind of get to the purpose of this. The tax code could be quite fun, and when I say fun, really in strategizing to reduce your tax burdens, utilizing it to its advantage. It's about 5,000 pages deep. 2/3 of it is just how to use the strategy and plan it effectively so you can reduce your taxable income, whether you're a business owner or a real estate investor. What we covered today is just it's a small portion of what's out there, but cost seg is really truthfully the gateway strategy to higher level tax planning. If you own a rental property, you own a business, you're an investor in one, or your network it's a great strategy to get in front of them, because this really does differentiate yourself from, say, another individual within your profession. Good to know is that it's an IRS approved method, so we're not speaking TikTok tax incentives or results here. This is actually tried and true. Help strengthen your loyalty amongst your network. Right, be their Yoda, be their guiding light. If you're hearing about improvements, could be additional opportunities for tax incentives. That's what I always think. I hear if you're putting money into a property, I'm thinking there's a way to maximize that incentive. We learned about rep status, short-term loophole. Easily, these two could have their own hour discussion, because these really do dive deeper into what we just covered today. But ultimately, work close with your CPA, your tax team. Make sure these align with your strategy, your planning. Don't let the tax tail wag the dog, but if you can utilize the incentive towards your benefit, always best to put that forward. If anyone has any questions, feel free to reach out to me. Here's my contact. Here's me in a nice blue jacket as well. But again, like I said, this is just kind of the tip of the iceberg, if you will, for tax incentives for real estate investors or business owners. But Evan, I want to say thank you for having me on here. Hopefully, the group found this insightful. If you have any questions, feel free to either ping Evan or myself. But I'll turn it over to you guys, or any other questions that come up.
Lots of great information here. Thank you, Sean. Looks like Matt has another question. Says, if my spouse is building up for hours for her rep status, interacting with contractor, project manager, ordering supplies, etc., but I also help by accumulating hours, etc., researching investment properties to acquire, corresponding with lenders, turning Airbnb units, can I put my hours under her account? It's a good question.
It's a good question. That really kind of goes into like the gray area of who's doing the activity. I will say, at least in this part that you wrote, or you kind of talked about some of the researching investment properties to acquire, that type of activity actually doesn't go towards your real estate professional status or your activity. Like if you're going to conferences, like learning items, or if you're researching, it's all going to be post acquisition. That's when the clock starts. That's when you want to start tracking those types of activities and hours. Very good. Yep. Thank you. I don't think I see any others. Let me check the Q&A.
Like BJ is putting in another question. Second. I could also turn your microphone on if anyone wants.
Oh, appreciate that, Matt. Thank you. And I think to confirm, the copy, or this was recorded, so if you want a copy, or I think you are going to get a copy of it. But if you
That's
want
right.
a copy of the slide deck, feel free to ping Evan or myself.
Okay. Looks like BJ. Are there any tax strategies that can help W-2 earners who don't have short-term rentals, but own long-term?
Uh, I mean, I would say there's probably a few you could probably look into, but that really gets out of what I specialize in, and that's really going to get into more of the kind of entity structuring, tax advising side. I'd say if you are a W-2 earner and you own long-term rentals, it's probably best to work with a tax advisor who specializes in real estate or businesses, because they're going to understand the tax code is going to be most favorable for you. So there's probably a few, but they're going to be a little more limited than like the ones that we looked at today. I don't think you're going to get like kind of the 1-2 punch in terms of deductions and maximizing it. But there certainly are some types of incentives you can utilize. Mhm. Yep. Yeah, appreciate it.
Another 30 seconds or so. Once again, Sean's information is up on the screen. Feel free to reach out direct. I believe most of you should know me and have my email as well. It's Evan, EVAN, at rehabfinancial.com. Obviously, you could reach out direct to me as well. Thank you, Gordon.
Appreciate that. Yeah, thank you.
Okay. Well, Sean, I want to thank you again.
Mhm.
Really great presentation. Really appreciate you taking the time. Thank you to everyone on the call. And again, if anyone has any other questions, obviously you can reach out to us direct. And again, interesting subject, at least to me. So lots of information to digest here.
Yeah, it may spark some interesting conversation at the Thanksgiving table. Just sit down with your family and friends. And go, have you heard about cost segregation? Let me tell you about it. It's the eighth wonder of the tax world.
It's amazing. It's amazing. It's complicated, but can be. So,
Yeah.
but really good stuff. So, once again, thank you everyone, and hope all of you have a great rest of your evening. And we'll chat soon. Thank you. Take care, all. Bye.